to the Weekly Spark, your fast 5-minute flash of insight into the world of mortgage and real estate. Every week, we're here to ignite your understanding of the market, from mortgage rates and housing trends to legislative updates and insider strategies. So let's strike the match and spark your week. This is the Weekly Spark.
First week of November, we're back in action. Got Halloween out of the way. Let's jump in. Jason, how are you today?
Doing good. It looks like we skipped Thanksgiving in my neighborhood and went straight to Christmas, but that's okay because my wife loves the Christmas trees and all the lights, so we're ready.
Awesome. All right. First up, jobs report came out this morning as of recording on Wednesday. The good, the bad, and the ugly. What do you got?
Yeah, so the government obviously is still shut down, right, Ryan? But we did get the ADP report, which, as many people know, ADP is one of the biggest payroll companies in the country. And here's the good. So the estimate that we received was higher than expected. So the jobs created were higher. So that's the good, right? Well, the bad is that the estimate was only that we were going to have 24,000 jobs, which is very weak. But we got 42,000 jobs created in October. So here's the deal, though. Like, the ADP reported there were job losses in August and September. So think about this. 3 out of the prior 4 months, over the last 3 months, there's only been a total of 10,000 jobs created. So just think about that. That's nationwide, 10,000 jobs created. So it's pretty bad place to be in terms of job creation. And just looking a little bit deeper at today's report, you have small, medium, and big size companies, right? The only size company that had gains were the large businesses, which are ones that have 500 or more employees. 75% of people work at small and medium-sized businesses, so it really is affecting the middle class, Ryan.
Yeah, I have a hard time believing the numbers at this point too, and I'm sure there'll be some sort of a revision on this later on. So that kind of leads us into the next one. Obviously, the jobs report has a lot to do, or supposedly has a lot to do, with the December rate cut coming up. What do you think this does for that?
Yeah, so we did get that quarter rate cut last time, as we kind of talked about last week. The Feds now, though, there was an 80% chance that we were going to get rate cuts again in December. But, as of right now, I don't believe the Fed will cut again without the official BLS jobs report and the PCE data. PCE is personal consumption expenditures, and that just measures how people are spending. So today's report really wasn't enough to sway them either way. So unless the government gets their stuff together and reopens soon, and that data gets released ahead of December 10th, I think the Fed will likely be on hold, unfortunately. So we are seeing a capitulation in the bond market. So we'll probably see some worse rates. The good news is we're ahead of it. We knew that we got a lock alert today. So we were able to help some clients before that rate drop occurred.
Awesome. And our last topic, we've got a loan spotlight this week, is going to be talking about down payment assistance loans. And I'll go ahead and take this one, Jason. So a lot of times we get clients that come to us and say, I need some down payment assistance to make this happen. And whether it's a first-time home buyer reaching out and asking questions about getting money to buy their house, right? In most cases that we end up finding after we actually review the client's situation, we find out that they do have some money that they can use for the down payment. If we shift those closing costs and ask for those from the seller, we can get those covered. And then we end up putting them into a different program versus a down payment assistance loan. Why would we do that? I thought these things were great. They're not most of the time. There's been one that's been in my area where they've given like $60,000, up to $60,000. This ends up haunting this home buyer later on in life. And I say that because they're using the $60,000. It seems like they have that in equity, but it's eating up all the equity. It's basically a second loan that they never get forgiven. So when they go to sell that house 2 years from now, they have to pay off that $60,000, and then they're right back where they started. It's not getting people ahead, and that becomes an issue. And so if you're seeing a ton of advertising around down payment assistance loans, make sure we're double checking what the behind the scenes is. A lot of these carry higher interest rates. A lot of these carry higher fees. And we even have programs like a 1% down payment program that allows us to kind of exit the down payment assistance platform, gets them a better loan rate, gets them a better scenario long term, and they only have to bring 1% down. They're not bringing as many fees. It's a fantastic program. So it allows us to kind of take a look at the whole situation, make sure we're assessing the borrower, not just throwing them in there because it's easy.
Yep.
Awesome.
Good point.
Well, thanks, man. I appreciate you being on. We got quick and clean this week. Let us know if you got any questions. We're here to help. See you on the next one.
That's a wrap for this week's edition of the Weekly Spark, brought to you by Creative First Mortgage. If you've got questions or want us to cover something next week, please let us know, shoot us a message, and until then, keep your deals moving and keep your week lit. See you next time.